Markets don't always move loudly when something important is building underneath. Right now, the surface looks calm, but the structure underneath is changing slowly. This kind of calm usually appears before positioning begins, not after moves finish. Most people confuse silence with safety, and that assumption often costs timing. Smart money does not need noise to act when conditions are aligning. They prefer quiet periods because attention is low and mistakes are fewer. This is the phase where positioning happens without headlines or excitement. Price action feels boring, but behavior starts becoming more intentional. When markets slow down without breaking structure, it signals internal strength. Weak markets collapse during quiet phases, strong markets compress instead. Compression is not stagnation. It is preparation for directional continuation. Right now, many assets are holding levels instead of rejecting them aggressively. That holding behavior matters more than short-term candles or indicators. Professional money watches reactions, not predictions during these phases. How price responds to small pressure tells more than any forecast. At the moment, reactions are controlled, not emotional or panicked. That usually means larger players are comfortable with current positioning. Retail often waits for confirmation that only appears after movement starts. By then, the best risk positioning has already passed quietly. This channel exists to help you recognize these moments early, not to predict tops or bottoms, but to understand market behavior. Understanding behavior keeps you aligned while others chase movement. Right now, volatility is present, but it is not chaotic. Chaotic volatility looks sharp, fast, and emotional. This volatility feels measured and selective. That difference separates preparation from distribution. Liquidity is still available, but it is not rushing into headlines. Liquidity patience is a sign of confidence, not fear. Markets do not reward impatience during these stages. They reward positioning and discipline. This is why quiet phases matter more than explosive ones. Explosive moves attract attention, but preparation creates opportunity. The problem is, most people only focus when excitement appears. By then, risk is already elevated. Right now, risk is being shaped, not released. This is the stage professionals respect the most. They build exposure slowly without needing confirmation. Confirmation comes later after positioning is complete. That order is important and often misunderstood. If you learn to read this phase correctly, you stop chasing noise. You begin aligning with structure instead of emotion. That alignment is what we focus on here consistently. Not daily predictions, but behavior-based clarity. In the next part, we will break down what specifically signals this preparation phase and how you can avoid misreading calm markets as inactive markets. What professionals watch next is not price movement, but reaction quality. Reaction quality shows whether buyers are defensive or confident. Right now, pullbacks are being absorbed instead of rejected sharply. Absorption is a sign of interest, not exhaustion. Exhausted markets fail quickly when pressure appears. Prepared markets pause and hold when pressure tests them. This holding behavior reduces downside volatility gradually. Reduced downside volatility builds internal confidence quietly. Confidence shows up through patience, not aggressive buying. Aggressive buying usually appears after confirmation, not before. Before confirmation, smart money prefers controlled exposure. Controlled exposure limits risk while allowing positioning. That is why volume looks steady, not explosive. Steady volume signals intention rather than speculation. Speculation creates spikes, intention creates stability. Stability is often boring, but it is powerful. Boring phases shake out emotional participants slowly. Emotional participants demand fast rewards. Markets rarely reward urgency during preparation phases. This is why many people feel frustrated during calm periods. Frustration leads to overtrading and poor timing. Professionals do the opposite. They reduce activity. Reducing activity allows clearer observation. Clear observation improves decision quality. Right now, decision quality matters more than prediction accuracy. Predictions can be wrong. Behavior is observable. Markets are currently behaving with restraint. Restraint often precedes directional expansion. Expansion does not arrive suddenly without warning. It arrives after structure forms quietly. Structure forms through repeated support reactions. Those reactions are happening consistently now. That consistency matters more than daily headlines. Headlines react to price, price reacts to positioning. Positioning always comes first. If you understand positioning, you stop fearing quiet markets. You start respecting them instead. Respect creates patience. Patience creates advantage. This is how professionals stay ahead without excitement. They accept boredom as part of preparation. Preparation is uncomfortable but necessary. This channel exists to help you stay disciplined during these moments. Not to entertain fear, but to explain behavior clearly. In the next part, we'll look at what usually breaks this quiet phase and what signals indicate transition from preparation to expansion. The quiet phase usually ends when participation begins to widen slowly. Widening participation does not mean excitement, it means acceptance. Acceptance appears when fear starts losing control. Right now, fear is present, but it is contained. Contained fear allows rational positioning. This is when institutions begin layering exposure carefully. Layering means entering in stages, not all at once. Stages reduce regret if conditions shift unexpectedly. That flexibility keeps professionals calm during uncertainty. Retail traders often lack this flexibility. They commit emotionally instead of strategically. Emotional commitment increases stress during pullbacks. Strategic commitment expects pullbacks naturally. That expectation changes reaction quality significantly. Currently, reactions to pullbacks are measured, not impulsive. Measured reactions suggest preparation, not distribution. Distribution looks frantic and unstable. Preparation looks patient and controlled. Another sign of preparation is reduced reaction to bad news. Negative headlines no longer cause sharp breakdowns. This resilience is rarely accidental. Resilience forms when buyers are already positioned. Positioned buyers defend structure quietly. They do not need aggressive rallies to feel confident. Confidence appears through holding behavior. Holding behavior is visible across multiple sessions now. Multiple sessions of holding matter more than single-day spikes. Spikes attract attention, but holding builds structure. Structure is what institutions trust most. Trust allows them to increase exposure gradually. Gradual exposure avoids detection and slippage. That is why moves often feel sudden to the public. The public only notices after positioning is complete. By that point, risk is already elevated. This is why preparation phases feel invisible. They are not designed to be obvious. Obvious signals attract competition. Smart money prefers quiet environments. Quiet environments allow cleaner execution. Execution quality matters more than entry timing. This is a lesson many traders learn too late. Markets reward execution, not excitement. That reward comes later, not immediately. If you understand this phase, you stop demanding instant validation. You allow structure to mature instead. That maturity is what creates durable moves. In the next part, we'll examine where most people misinterpret this stage, and how those misinterpretations create avoidable losses. Most people misread this phase because it does not match their expectations. They expect markets to reward activity, not patience. This expectation creates pressure to act unnecessarily. Unnecessary action often leads to poor positioning. The first common mistake is assuming opportunity has already passed. Calm markets feel late to emotional traders. In reality, calm often appears before opportunity becomes visible. Another mistake is waiting for perfect clarity. Perfect clarity rarely appears before moves begin. Clarity usually arrives after positioning is complete. Those who wait for certainty enter with higher risk. Higher risk increases emotional stress quickly. Stress reduces decision quality during normal pullbacks. Another misinterpretation is confusing consolidation with weakness. Consolidation builds strength, not failure. Weak markets cannot hold structure during quiet periods. Strong markets can. Right now, structure is holding across multiple sessions. That holding behavior matters more than short-term fluctuations. Another mistake is overreacting to single-day news. Single-day reactions rarely define direction. Direction forms through repeated behavior over time. Time is the filter most traders ignore. Ignoring time leads to impatience. Impatience leads to forced entries. Forced entries often happen at poor prices. Another misreading is focusing on commentary instead of reaction. Commentary is subjective, reaction is observable. Markets react honestly even when commentary is misleading. Another mistake is anchoring to previous highs or lows. Anchors distort perception of current structure. Markets do not respect emotional anchors. They respect liquidity and behavior. Another misinterpretation is assuming institutions act loudly. Institutions prefer discretion, not attention. Attention increases cost and risk. Discretion allows smoother positioning. Another mistake is treating boredom as danger. Boredom is not danger, it is preparation. Preparation often feels uncomfortable emotionally. Comfort rarely precedes opportunity. Another error is chasing confirmation after small moves. Small moves are often tests, not signals. Signals come from consistency, not bursts. Consistency is visible now. Those who recognize it stay calm. Those who don't feel anxious. Anxiety pushes premature decisions. Premature decisions are difficult to recover from. Understanding this phase removes that anxiety. It allows observation instead of reaction. Observation creates clarity over time. In the next part, we will explain what signals actually matter right now, and how to stay aligned without forcing trades. What truly matters now are signals that appear boring to most observers. These signals do not trend on social media or headlines. They appear quietly through repeated behavior. One important signal is how markets respond to minor stress. Right now, minor stress does not create instability. Instability would show through sharp rejection. Instead, reactions remain controlled and proportional. Proportional reaction indicates confidence underneath. Another signal is how liquidity behaves during pullbacks. Liquidity appears patiently rather than aggressively. Patient liquidity suggests preparation, not desperation. Desperation always shows through urgency. Urgency is currently absent. Another signal is duration of holding at key levels. Markets are spending time rather than rejecting levels quickly. Time absorbs uncertainty gradually. Absorbed uncertainty reduces downside risk perception. Reduced risk perception encourages planning. Planning capital behaves differently from trading capital. Trading capital reacts quickly. Planning capital observes. First, right now, observation dominates activity. This dominance is not accidental. Another signal is how volatility behaves intraday. Volatility exists, but does not escalate emotionally. Escalating volatility signals loss of control. That is not happening now. Another signal is the absence of forced selling. Forced selling creates cascading moves. Cascades are currently missing. Missing cascades indicate stability. Another signal appears in failed breakdown attempts. Breakdowns do not follow through convincingly. The lack of follow-through signals hidden demand. Hidden demand supports structure quietly. Another signal is sector behavior alignment. Leadership sectors are holding rather than rotating aggressively. Aggressive rotation often precedes instability. Stability appears when leadership remains intact. Another signal is overnight session behavior. Global sessions remain aligned rather than divergent. Alignment reduces risk for larger players. Reduced risk enables positioning. Another signal is narrative silence from institutions. Less commentary often means more execution. Execution does not require explanation. Markets move first, narratives follow later. This sequence repeats consistently across cycles. Those who understand it remain calm. Those who do not feel pressure. Pressure leads to rushed decisions. Rushed decisions usually occur at poor locations. Avoiding pressure is an advantage. That advantage is forming now. Understanding these signals allows patience without fear. Fear only appears when structure is unclear. Structure is becoming clearer quietly. In the next part, we will focus on what not to do during this phase, and how to avoid the mistakes that remove people from opportunity early. The biggest risk now is not market weakness. The real risk is behavioral error. Behavioral mistakes appear during quiet phases. Silence makes people uncomfortable. Discomfort creates impatience. Impatience leads to unnecessary action. Unnecessary action usually damages positioning. This is where most participants fail. They mistake inactivity for danger. Danger requires evidence, not emotion. Right now, evidence does not support fear. Another mistake is seeking constant confirmation. Confirmation rarely appears loudly. It reveals itself through consistency. Consistency is already present. Another error is switching bias too frequently. Bias changes weaken conviction. Conviction requires time, not noise. Noise creates distraction, not clarity. Another mistake is reacting to social sentiment. Social sentiment amplifies emotion. Emotion distorts timing. Timing matters more than prediction. Another error is overanalyzing every small move. Small moves exist within structure. Structure defines direction, not fluctuations. Another mistake is abandoning process for excitement. Excitement feels rewarding temporarily. Temporary reward weakens discipline. Discipline protects capital long term. Another error is copying others blindly. Other strategies may not fit your timing. Fit matters more than popularity. Another mistake is forcing trades during boredom. Boredom is not a signal, it is a test. Those who pass boredom stay aligned. Those who fail boredom exit early. Another error is assuming institutions move emotionally. Institutions move strategically. Strategy unfolds gradually. Gradual movement avoids attention. Avoiding attention preserves efficiency. Another mistake is ignoring risk entirely. Risk always exists. Ignoring it creates vulnerability. Acknowledging risk creates control. Control allows patience. Patience is the hidden advantage. Another error is mistaking speed for intelligence. Fast decisions often lack depth. Depth builds durability. Durable positioning survives. Noise. Noise fades. Structure remains. Understanding this changes behavior. Behavior alignment matters more than opinion. Opinion fluctuates. Behavior persists. This phase rewards restraint. Restraint is misunderstood as weakness. In reality, restraint signals readiness. The market is not asking for action yet. It is asking for discipline. In the next part, we will explain how professionals prepare during this waiting phase, and how preparation quietly separates outcomes later. Preparation during quiet phases is rarely visible, but it is constant. Professionals do not wait passively, they prepare actively. Preparation begins with scenario mapping. Multiple outcomes are considered calmly, no single outcome dominates thinking. Flexibility remains intact. Another preparation step is capital organization. Capital is allocated mentally before deployment. Mental allocation reduces emotional reaction. Another step is reviewing risk boundaries. Risk limits are clarified, not adjusted impulsively. Clarity prevents panic later. Another preparation step is monitoring liquidity behavior. Liquidity reveals institutional comfort. Comfort supports sustained positioning. Another step is studying reaction, not headlines. Headlines explain after movement. Reaction leads truth. Another preparation behavior is patience rehearsal. Patience is practiced deliberately. Waiting is treated as skill. Skill improves execution timing. Another step is emotional detachment training. Emotions are acknowledged, not followed. Detachment sharpens observation. Another preparation step is reviewing failed breakdowns. Failed breakdowns indicate hidden demand. Demand precedes expansion. Another step is tracking correlation stability. Stable correlations signal structural health. Instability warns caution. Another preparation behavior is reducing noise exposure. Less noise improves signal clarity. Clarity improves decision quality. Another step is reviewing historical patterns. History does not repeat exactly, but behavior often rhymes. Another preparation step is stress testing assumptions. Weak assumptions are replaced quietly. Strong assumptions survive scrutiny. Another behavior is aligning time horizons. Short-term noise is separated from long-term structure. Separation prevents confusion. Another step is position sizing rehearsal. Sizing is planned before emotion appears. Planning prevents impulsive scaling. Another preparation behavior is reviewing exit logic. Exits are defined before entries. Defined exits reduce fear. Another step is monitoring volatility compression. Compression often precedes expansion. Expansion rewards prepared positioning. Another preparation behavior is maintaining neutrality. Neutrality allows adaptability. Adaptability preserves opportunity. Another step is observing leadership behavior. Leaders move first quietly. Followers react later loudly. Another preparation step is studying participation breadth. Broad participation supports sustainability. Narrow participation warns fragility. Another behavior is aligning mindset with process. Process replaces prediction. Prediction invites frustration. Another preparation step is conserving energy. Energy is reserved for decisive moments. Decisive moments require clarity. Another behavior is trusting preparation. Preparation reduces doubt. Doubt causes hesitation. Hesitation costs position. This phase is about readiness, not action. Those prepared act calmly when time arrives. Those unprepared react emotionally. Markets reward readiness, not speed. In the next part, we will explain what signals indicate preparation is complete and how transitions from waiting to action quietly begin. Preparation eventually reaches a transition point. This transition is rarely announced. It appears through subtle behavior changes. One signal is improved response consistency. Markets react similarly across different news types. Consistency reflects internal alignment. Another signal is reduced downside follow-through. Negative events fail to extend declines. Failure reveals absorbed selling. Another signal is improved intraday recovery. Early weakness is bought calmly. Recovery happens without urgency. Another signal is tightening ranges with intent. Ranges compress without panic. Compression suggests energy building. Another signal is leadership stability. Leading assets hold levels quietly. Holding matters more than rising. Another signal is volume balance improvement. Volume supports direction, not spikes. Balance signals control. Another transition signal is overnight stability. Global sessions remain aligned. Misalignment fades. Another signal is sentiment fatigue. Fear stops escalating. Optimism does not explode. Balance returns. Another signal is technical acceptance. Key levels hold repeatedly. Repetition builds confidence. Another signal is rotation harmony. Rotation occurs without disruption. Harmony supports continuation. Another signal is volatility acceptance. Small volatility is tolerated calmly. Tolerance indicates readiness. Another signal is narrative quieting. Stories lose urgency. Price behavior dominates attention. Another signal is liquidity smoothness. Orders fill without distortion. Smooth fills build confidence. Another transition signal is patience reward. Waiting no longer feels costly. Calm replaces urgency. Another signal is reduced false signals. Breaks either hold or fail cleanly. Clarity improves execution. Another signal is professional silence. Less public commentary appears. Action increases quietly. Another signal is internal confirmation stacking. Multiple indicators align gradually. Alignment replaces guessing. Another transition signal is timing flexibility. Entries are no longer rushed. Opportunities repeat. Another signal is risk comfort. Risk is acknowledged calmly. Calm risk supports scale. Another signal is reduced hedging pressure. Protection becomes strategic, not reactive. Another signal is structural patience. Markets accept time at levels. Time absorbs supply. Another transition signal is confidence without excitement. Confidence feels boring. Boring is powerful. Another signal is execution readiness. Plans feel clear. Execution feels natural. This is when preparation converts into action. Not suddenly, but deliberately. In the next part, we will explain how institutions initiate action without triggering attention, and how scale begins invisibly before momentum appears. Action never begins with headlines. It begins with silent execution. Institutions move when alignment feels complete. The first action is controlled entry, not aggressive, not emotional. Controlled entries protect position integrity. Capital enters without disturbing structure. Structure remains calm. Another action is layered execution. Orders are split carefully. Splitting hides intent. Another action is time dispersion. Entries occur across sessions. Time reduces visibility. Another action is liquidity testing. Small orders probe depth. Depth confirms readiness. Another action is passive positioning. Limit orders dominate. Market orders reduce. Another action is risk calibration. Stops are placed strategically, not emotionally. Another action is exposure symmetry. Longs increase gradually. Shorts reduce quietly. Another action is duration extension. Holding periods lengthen naturally. Trust builds. Another action is patience reinforcement. No rush follows confirmation. Discipline holds. Another action is internal coordination. Funds align exposures quietly. Coordination strengthens impact. Another action is narrative avoidance. No public justification appears. Silence protects execution. Another action is reaction monitoring. Markets respond calmly. Calm validates decision. Another action is capital layering continuation. Additional layers follow confirmation, not anticipation. Another action is volatility tolerance. Minor swings are ignored. Tolerance reflects conviction. Another action is range respect. Entries respect structure. Structure defines safety. Another action is overnight positioning. Positions remain through sessions. Confidence holds overnight. Another action is correlation monitoring. Assets move cohesively. Cohesion confirms health. Another action is downside assessment. Pullbacks are evaluated rationally, not feared. Another action is expectation control. Returns are not rushed. Process dominates outcome. Another action is scale patience. Scale waits for response. Response dictates size. Another action is professional detachment. Emotion is absent. Process leads. Another action is silent reinforcement. Successful entries are repeated. Repetition builds exposure. Another action is exit optionality. Exits are planned, not anticipated. Another action is structural trust. Markets behave as expected. Trust deepens. This is how action unfolds without spectacle, quietly, methodically. In the final part, we will connect preparation, confirmation, and action into one complete framework, and explain how to stay aligned without chasing momentum. Everything now comes together naturally. Preparation created structure. Confirmation created confidence. Action followed discipline. This sequence is never random. It repeats across cycles. Most people miss it because it feels uneventful. Silence feels uncomfortable. Comfort seeks excitement. Professionals seek alignment. Alignment produces durability. Durability outlasts hype. This is why timing matters more than speed. Speed creates mistakes. Timing creates opportunity. Markets reward patience repeatedly. They punish urgency consistently. This phase tests emotional discipline, not analytical skill, not prediction accuracy. The market does not ask for opinions. It responds to behavior. Behavior reveals intent. Intent determines outcome. When you understand this framework, you stop chasing confirmation. You start observing structure. Observation sharpens execution. Execution becomes calm. Calm builds consistency. Consistency builds confidence. Confidence compounds results. This is not about predicting tops or bottoms. It is about reading readiness. Readiness appears quietly, always has, always will. Those who wait feel late. Those who rush feel regret. Those who align feel steady. Steady participation survives volatility. Survival enables growth. Growth follows structure. Structure rewards discipline. This is the mindset professionals protect. Not excitement, not certainty, but clarity. At Market Pulse USA by AB, we focus on clarity over noise. So you understand what matters. So you act without pressure. So you stay aligned through January and beyond. In the next video, we will break down how this framework applies to live market conditions right now and how to use it daily without overthinking. Stay patient, stay observant, stay disciplined.